I would like to start this year with a moment of introspection and review, as I feel that over the last 12 months, we have seen some sizable changes in Japan and the investment landscape. Those of you who read my previous commentaries have seen that I reiterated the mission statement and my beliefs for my strategy. Keeping it simple, and in the founding tenements I set out for the strategy some 15 years ago, as well as the SPARX strategy, where the fundamental bottom-up analysis we perform leads to our macro understanding. Simple and intelligible business model, inherently sound business, a well-capitalized balance sheet with little debt, durable competitive advantage, above-average return on equity and sustainable earnings growth, consistent and ample cash flow generator, run by exceptional management. This is a simple list in isolation, but its application and diligence to continually reassess the information with fresh and changing perspectives is what has given SPARX our edge for over 30 years. It is this challenging of existing paradigms that drove the evolution of my understanding and overall strategy. Remaining true to the above guidelines but challenging the dogma around the value stock universe to uncover the growth stocks in disguise that I have talked about previously. I remain cautiously optimistic about the general Japanese economy, but I have never had our fate tied to a simple Japanese growth story. We have selected a group of world-class companies that I believe can thrive and grow even in a deflationary low-growth economy should Japan slip back from the precipice of economic resurgence. In the past 12 to 24 months, we have seen a resurgence of the Japanese value portfolio, with some of my peers performing admirably, and Japan has seen the favorable tailwinds of a surging index. My style of diversified concentration in the strategy allows us to remain true to our beliefs and lets the hard work and research on which our returns and performance speak for itself, beyond the restrictions placed on the taxonomy of style and not reliant on an upward trending index. I have written and spoken about the macro outlook for Japan, and I feel much remains the same today as when I wrote or spoke about it. Much of Japan's return to economic normalization is still early in its story, and only time and evidence of the change will confirm the outcome. As I have said before, I remain cautiously optimistic for the future of Japan. The return to inflation and the weakness of the yen have sometimes dominated the conversation about Japan this year. Inflation is looking increasingly likely to remain, but we wait for the spring wage negotiation results to understand more about the nature of the drivers. We are often asked about the yen weakness and its impact on the portfolio, but my response is generally that our high-quality portfolio companies have the ability to weather currency fluctuations. The monetary policy of the Bank of Japan is part of this story with its continued low rate support. But I think the world is generally accepting of a return to positive rates in 2024, no matter how small the change is. An interesting topic is the current account balance of payment surplus that has generally been seen through Japan's position as a global exporter in the past. But now with some domestic money flowing out into financial instruments where previously there was often a demand to repatriate the money, there's more comfort to leave the capital in regional currencies like dollar or euro. Hence, there is a lower demand for yen. For me, the more important topic is the systemic changes brought about through the corporate governance reforms we have seen in Japan since 2014. These, I feel, are a bigger driver than currency fluctuations associated with the yen's strength or weakness. I would like to talk about two of my biggest gainers, as well as one of the main detractors for the year 2023 in my strategy. Hitachi, I believe, continues to lead the way in redefining how a conglomerate can operate. They have a wide business portfolio, but they do not possess a dominant share in most product categories. However, being a conglomerate enables Hitachi to utilize its expertise in IT services, mission-critical social infrastructure operations, and manufacturing across various fields. The range of internal resources has expanded through the reorganization of the group over the past decade, which included acquisitions of new assets such as Global Logic and Hitachi Energy. Conglomerates are generally perceived as an inefficient collection of divisions, but Hitachi is finding ways to leverage the unique collection of business to make the whole greater than the sum of its parts. Mitsubishi Corporation has been a name I have supported for many years, even before Mr. Buffett saw the value of the stock. A stock that traces its roots in wholesale trading in Japan. After many years of intelligent investment activities, which leveraged on its expertise as a general trading house, the firm's balance sheets today represent a unique collection of operating businesses, operating assets, and investment securities with a wide variety of geographical exposure in industries that are not easily accessible through other means of investments. Their assets span globally: natural commodity project in Australia, truck assembly supply chain business in Southeast Asia, renewable energy power generation business in Europe and the US, convenience store operation in Japan, and so on. They continue to look like a great investment, and with the introduction of the progressive dividend scheme, but also aggressive share buybacks were particularly positive for Mitsubishi Corporation. Socionext is the largest detractor for 2023. It is easy to talk about the positive names and overlook the names that didn't perform. The company's projection that the revenue and profit growth would plateau was poorly received, causing the stock price to fall since July. However, the company retained all the elements to become a great contributor in the future. They sit more on the growth frontier, but still meet the criteria I spoke about earlier. They have implemented an organizational reform and globalization of its business, resulting in rapid changes in customer composition and the amount of design wins since 2018. They have become more internationally focused, with now 80% of their non-recurring engineering revenue coming from overseas versus 3 years ago. That number was around 30%. With Moore's law reaching its perceived limits, I believe that chip design will become increasingly important in the future. Socionext was created with the merging of divisions from Panasonic and Fujitsu. This has meant that they have a large pool of human capital in the form of chip design engineers at a time when these skills are increasingly in demand. We do note the trend for in-house design of chips like those by Apple and competition on the international stage. But the global appetite for customized system on chips, or SoCs, generally shows no sign of slowing, and Socionext is well placed to benefit from this, especially if the AI revolution does finally come to fruition in a meaningful way. Japan enjoyed a great 2023, and the stage seems to be set for that to continue into 2024. We have built a strategy that doesn't rely on that growth story, but will also benefit from it when it does happen.